Oh, excuse me. Hello, everyone. Welcome. Today, I'm just going to go over Oricon 4800, and I also have a special request from a viewer on a stock. Let me bring up one. What stock? Which was it again? The stock was from Leonard G. He wanted me to take a look at 8771 eGuarantee. Now, I have no idea what this company does, so this is going to be new for all of us. So, okay, let's change the ticker. Let's start off with the request first, and then we'll do Oricon. Okay, eGuarantee, let's take a look. So share price wasn't really affected in 2020. Went as high as around almost 2,800. Currently around half that, just over half that. What does the company do? eGuarantee, together with its subsidiaries, engages in credit risk entrustment and securitization business in Japan. It offers services for business corporations that include undertaking the risk of uncollected commercial receivables arising between business companies, such as sales of receivables or accounts receivables. The company also provides services for financial institutions, including service to accept the risk associated with financial claims that arise when guaranteeing trade receivables for companies and advance payment for corporations. It conducts sales activities through sales networks such as trading companies, leasing companies, insurance agency, and credit unions. The company was incorporated in 2000. Okay. Undertaking the risk of uncollected commercial receivables arising between companies. Okay, do they sell insurance on that, or are they just seems there's two arms, right? One is either they insure against this happening, or or another thing that they could do is probably just purchase the accounts receivables at a discount, and then they go to claim the receivables, giving the company instant cash flow, not having to deal with the legal process. Interesting. Take a look at income statement. Wow. So business has been doing well. Business has been doing well. They've doubled their sales. So yeah, this is in COVID. This would be better. This would be even better during COVID than before COVID, I would imagine. So let's see here. Revenue's doubled in around 7 years. And then gross profit also doubles. So stable gross profit margins. SG&A actually didn't increase that much, which is interesting. That could be the same amount of employees, but the size of the claims go up in the sizing, meaning they're handling probably higher accounts receivables. Maybe. Nice. Okay, let's take a look at profitability. How profitable is it? Wow. Really high EBIT margins. So people really just don't want to deal with this type of stuff, eh? Yeah. So it seems more like a labor-intensive type of business model where, like, well, it doesn't even have to be, right? Like, I think with AI, you can literally send an email asking people to pay you, right? Or draft a lawyer letter to people and say, like, hey, you know, you're due. Like, we own this debt now. You got to pay us, right? Yeah, SG&A margin has actually gone down, meaning there's operating leverage, which is nice. Gross profit margins have stayed relatively stable. Okay. Meaning they probably just price it the same way regardless of size or volume. Yeah. So they probably buy at like 20% cost. Is that a way to look at it? I wonder. Interesting. Take a look at interest value. Okay, cash balance has gone up. They spent a little bit. EBIT margin has gone down recently. Sorry, EBIT multiples have gone down as low as 10 times. Not that expensive, honestly. Yeah. Wonder what the growth trajectory is. Is there any analyst estimates on this company? There is. So expected to grow around like 12-13%. Gross profit margin staying around the same. Interesting. Free cash flow. How much do they spend on CapEx? Not a lot. I don't imagine them having to, honestly. Wait, how does that make sense? Because their EBIT was 5485. This is 500 difference. Oh, marginal difference. Okay. Okay. Nice margins. Let's think. When does this business do well? It probably does well when companies are more likely to default, right, on their on paying people back. So I would say the worse the economy does, the better for this business. But then the question is, how can they predictably increase sales, right? Like how's it possible they've doubled? Like, are there other players in this industry? Are they taking a market share? Like that's what makes the most sense, right? Okay, let's take a look. Or they could have expanded the types of accounts receivables across different industries. So they could be expanding different type of companies in which they're willing to, purchase these accounts receivables from. Their new business. Okay. They have English side. Nice. Status of acquisition trade. Are they buying my shares? That's nice. How many shares are they buying? So 480,000 shares, total acquisition price, cost of 723 million. So 7 million of shares. What's their market cap? So, okay. So around 700 million. CAD, US, probably around like 500, something around there. So just a small buyback then. Yeah, not a big acquisition, to be fair. Yeah, not a big dent. Welcome. We have 3 concurrent viewers right now. Welcome, welcome, welcome. Please, if this is your first time here, welcome. And if you guys have not subscribed yet, if you click subscribe, what will happen is a nice animation will come up and you will replace the recent subscriber. So please subscribe if you're new here. Nice. What do they say that next year's forecast is? Okay, 5200, and then okay. So a slight improvement is what they forecast. Do they have? Yes, this is what I'm interested in seeing. Okay, IP. Let's take a look. Guarantee liabilities increased by 9.9% year over year, reaching 826 billion yen. Guarantee liabilities increased as inquiries steadily expanded, driven in particular by the increased number of bankruptcies stemming from labor shortages and rising prices. Oh, interesting. Rising prices, rising costs, you mean? Meanwhile, this increase would also be a result of conducting careful screening in this environment. Net sales increased by 11.6% year over year. Okay, ordinary profit increased by 6.1%. The cost ratio increased due to a rise in guarantee payments, mainly in the first half, driven by the increase in the number of bankruptcies. But the thing is, okay, if you have a period of increased bankruptcies, will that result in a period of decreased bankruptcies? You know what I mean? So like, how can we be certain that? One question I have is, how can we be certain that the revenues will continue to increase? Now, this is good growth, right? This is not bad growth, but like, how do we be confident that's going to be the case? Balance of guarantee. Guarantee liabilities increased by the guarantee outstanding increased by 33.4% year over year. Guarantee obligations 1.885. Guarantee liabilities 826. What does that mean? So guarantee obligations, the total of the guarantee limits set for each covered company of the guarantee. The total of the guarantee limits set for each covered company of the guarantee. Guarantee limits liabilities amount. The total of, for contracts for which the balance of the receivables have been notified. The balance of receivables per each covered company of the guarantee. Number 2, for contracts for which the balance of receivables have not been notified. The guarantee limit set for each covered company of the guarantee. Guarantee liabilities. Guarantee obligations. Okay, if I'm interpreting this correctly, this is how much that's on their book in terms of obligations that they bought. Meaning, if I owe $1,885 for a laptop, right? Sorry, I'm a company that sold a laptop for $1,885, right? And I go around and, and someone has been in default for like 6 months, let's say, for example, right? And I go around and sell to this company and be like, hey, give me $826 for it. I don't want to deal with it. I wonder if that's what that means. Let me just double check. This is some new terminology for me. Guarantee obligations. The total of the guarantee limits set for each covered company of the guarantee. Okay, guarantee obligations are amounts in which if the person doesn't pay, you pay. So what this means is, let me think about how to phrase this. Okay, let's say same scenario. Let's say your Dell computers, right? And someone buys a computer from them for $1,800. And Dell comes to me and says, hey, this person's likely going to pay, but just in case they don't, I want to buy insurance on this, right? So that if they don't pay, so they pay some premium, right? Whatever that premium is, we don't know. But if that person doesn't pay, then you're on the hook for 1.8K essentially. So in this case, it's 1.8 billion yen, right? So if everyone decides to go bankrupt, tomorrow, like Godzilla, resurfaces in Japan and just literally, fires a Hadoukens the entire city, then they're probably on the hook for 1.8, maybe. So that's guarantee obligations. Guarantee liabilities. This is when the promise becomes a money risk. Okay, guarantee liabilities are essentially okay, so there's 2 steps in the process, right? First step is Dell's like, okay, I sold this 1.8K computer to this person, right? I want to buy insurance on this, so in case they don't pay me, you're on the hook for 1.8. You're like, sure, pay me this insurance, pay me for this insurance first. Like, okay, so total obligations, is 1.8K for that computer, you know, and then 6 months go by, they haven't paid, right? So as law is looking like, okay, you know, actually this is not the best example. That's not the best example. Let me rephrase that. That is like, sure you can. glad you can understand, you know. Street Fighter reference, by the way. Yeah. Dragon Punch. Okay. Welcome, Jason Tret. I have not seen you in the chat before. Welcome. Always nice to engage with new viewers. If you haven't subscribed yet, please subscribe. So guarantee liabilities is like, well, I guess in this case, this is like 45%, something like that, of customers aren't paying. So it'd be like, okay, 55% have paid now, but it looks like potentially 45% aren't going to pay, right? So then it's not like you actually have to dish out this 826 billion. What it's actually ended up happening is you're on the hook for going, you know, hunting these people down to get them to pay, right? So this is in the form of calling them, sending them an email stating, hey, we're the owners of this debt now. You got to pay us now, or else we're going to put well, in Canada, you would put like a lien on some of the property. You would say something like, oh, if you don't pay us, this is going to be bad for your credit, that sort of thing, right? So there's still a percentage of people that after you go through this step, be like, okay, we're going to still pay this, right? So this is a guaranteed liability. Is like, this is the likelihood of that, you know, this is the amount of balance that has been kind of, that needs to be hunted down essentially, right? But of course, still most people would pay for it, right? So what does that look like, right? So for example, what's an example, right? Like sometimes it's as simple as like, oh, you forgot to pay your phone bill, right? And then you close an account or something like that, and then you just forgot to pay it, right? You thought you paid it, but you didn't pay it, right? So then after you close your account, your phone provider bill, you know, you get it in a couple of months, you get like this credit agency coming after you and be like, hey, you didn't pay this. If you don't pay us this $50 or $60 after this really shark-like interest, then we're gonna screw up your credit score. And they're like, oh, dude, it's only $60, might as well pay it, right? So some of it is like that. So that has like a pretty high percentage probability of being paid off, I would say. Yeah. Thank you, Jason. Appreciate the sub. Helps a lot. How come I didn't get audio? Usually there's like some nice animation that comes out when that happens. Okay. Well, at least we see recent subscriber Jason Tret on the top right, so thanks for subbing. Yeah, this is like a new concept I'm trying to do. Just live streaming, rolling out content. I'm not a lazy person when it comes to creating content, so doing research, like I'm already doing research anyways, might as well, you know. Yeah, might as well do the research, you know, and upload it for free content, right? And try to build some follower base. So yeah. Net sales increased, steadily expanded, partly due to notable increase in bankruptcies driven by labor shortages and rising prices. Despite the continued upward trend in the number of bankruptcies, as a result, net sales increased by 11%, supported by steady increase in new contracts and high guarantee utilization among existing customers. So very good. So you get more contracts, and among existing customers, they're getting a higher guarantee utilization, right? So this is a new industry for me, so I'm gonna be taking notes here. All right, so if we think about like what are some like key metrics we want to be looking at, we want to looking at number of contracts / customers, and another thing is value of guarantee obligations over time, so year over year, something like that. So we just put something like that. Because even if the number of bankruptcy Oh, 721637. Thank you for subscribing. You have replaced Jason. Sorry, Jason. You know, that's what happens. Sometimes people get eager to subscribe. So, welcome 721637. That's an interesting username. Please engage in chat if you feel like it. Yeah, so we can't depend on just like bankruptcies increasing, right? Because there's a period of time where there's more bankruptcies, periods of times where there's less bankruptcies, right? What we want happening is potentially that could happen is the amount, you generate a trustworthiness as a company that can handle more guarantee utilizations. What I mean, like, if you're selling accounts receivables, right? You're trying to get them off your books, right? You don't want to concentrate all your risk to one provider, right? Potentially you want to diversify. If I was like Dell, for example, right? Instead of putting millions of dollars into just one company, because if bankruptcies do end up increasing above a certain percentage, right? It could actually be kind of irresponsible to put all your eggs in one basket, right? So potentially what is happening is, be like, oh, let's give eGuarantee some percentage of our AR book. And then over time, as they have shown their ability to, pay off, then we will give them more. So that could be a case. We don't know what the actual answer is. I'm just speculating at this point. These are things that are going through my head when I'm looking at stocks. Okay, the cost ratio. The cost ratio mainly in the first half due to the increase in guarantee payments associated with the rise in bankruptcies. Meanwhile, as the SG&A remained flat, profit growth was restrained. Okay, so for fiscal year 2025, net sales increased 11%, gross profit increased 6%, operating profit increased 5%. Business trends. The consolidated financial forecast is as follows. Net sales is 11.3. We expect it to achieve an increase in net sales and operating profit for 24 consecutive years. So net sales, consistently increase net sales, ordinary profit, number of bankruptcies. Interesting. So this is very interesting. So I'm very curious about how they're able to increase net sales when there's such a big gyration in number of bankruptcies, right? Because here there's only 6,000 bankruptcies, like 5,900 bankruptcies, yet their sales have gone up. That's interesting. How's that possible? How's that possible? If anyone in chat can figure out why that's possible, like it'd be nice to know if you guys have any insight. That was very strange to me how because I would feel like, hey, if bankruptcies increase by, let's say here, this is 20%, right? Do sales increase by 20%? Or at least when it drops from this and drops, let's say 33%. It's very interesting. How does that happen? So that's a question I have. How can bankruptcies decline yet net sales increase predictably over time? That is interesting. One part of the answer probably lies in being given more guarantee obligations with their existing customer base. That's how I would imagine that is the case. The guarantee fee rate has been on an upward trend since a risk portfolio reshuffle that was implemented up through the first half of fiscal year ending March 2025. Average guarantee fee rate. Analyze net sales during the calculation period. Guarantee obligation during the same period. Number of bankruptcies. Moving average of bankruptcies over 6 months. Yeah, so they're actually their fee rate has gone down actually. So I'm curious of why it would go down. Is it because instead of I'm giving you a contract for an accounts receivable for 100,000, maybe there's some discount where it's like, if you give me $1 million of accounts receivable rather than 100,000, then you get a more discounted rate. I wonder if that's the case, because in theory, right? Okay. If it takes one email, one phone call, one staff member, it doesn't matter if the amount is 100,000 or $1 million, right? It's the same amount of work. So that's where the operating leverage comes in. It's like the same amount of work, but the dollar amount is increased at a slight decline in the rate. So that's interesting. Still questions that I don't have answers for. Steady expansion expected due to the accumulation of guarantee liabilities amount, while increasing the number of contracts through the addition of sales personnel. While increasing the number of contracts through the addition of sales personnel, the company plans to maintain a cautious underwriting policy, taking into account the rising number of bankruptcies that are difficult to predict under the traditional screening model, which is affected by labor shortages and rising prices. Steady expansion is expected. Yeah, so I'm right. So the number of contracts, there's some relation between the number of contracts they can handle and the number of sales personnel. But it's not one-to-one, right? So slight relation, or I guess more sales personnel means more contracts that can be dealt with. Okay, dividend policy. Increasing dividends, good. 38 yen on, that's not a lot, that's just under 3%, so like. Main management index. Sales, ordinary income ratio, net assets per share. Capital adequacy ratio, okay. Distribution of share ownership. Individuals, domestic corporation, financial institution. ROE, ROIC 20% or more, dividend payout ratio 20% or more. Okay. The current reach of the potential market for credit risk management for business-to-business transactions is less than 10%. Invest thoroughly to develop the remaining more than 90% of the market. I'm not sure I understand the English here. If I'm getting the English correct here, I think what they're saying is, in terms of the types of business-to-business transactions that they're doing, they're only covering 10% of it. Not saying that their market share is 10%. Invest thoroughly develop the remaining more than 9% of the market. So like, so one market would be if someone leases a car from a car dealership, right? That would be one type of, that's B2C, not business to business. What would be a business to business? Oh, so Toyota and a car dealership would be a business to business transaction, right? So let's say that's something that they already do, right? Then what's another type of transaction? It could be the owner of a fishing boat selling their raw caught fish to a cannery, for example. That would be a business to business transaction. That's something they probably don't do, that they could do. I think that's the idea here. That's bullshit, but okay. Expand the range of receivables covered by the guarantee. Yeah, so I think that's the main thing. Profit growth. So that makes sense in terms of revenue expansion, right? Like even though bankruptcies are going down, they're expanding the amount of business-to-business types of transactions they can cover, so that would increase their revenues. But the fact that they only do less than 10% of all B2B transactions means that the company can still continue to grow. And then the question is, how come that they've been expanding so slowly, you know? Profit growth. Steady accumulation of guarantee liabilities. Strengthening sales structure in offices. Average operating cash flow of 3 billion yen or more over the past 3 years. One thing I find that's very interesting though, that I want to get back to real quick, is that I find that's really impressive is, how is it possible that they can remain profitable in here, right? There could be a period of time where like companies legit like go bankrupt and can't pay you, right? If they can't pay you, then what do you do? Right? Like, but the fact that they didn't suffer any losses means that like either this business model is just OP in that they have some type of collateral that they can able to get, or it's through some legal structure, or there's some intricacy about this business model allows them to always get paid. That's what I feel like is happening. Like, it must mean for them to only charge like 1.3%. The thing about it, right? Like, that means, you know, if default rates increase above like 1.3% here, for example, right? Or let's say it goes to 2%, then you're fucked, right? So how is it possible that there's this like sales is increasing constantly and there's never been a down year? That I think is, well, there's down year over here. That I don't know, but this could be just literally setting up the company for SG&A and having the right corporate structure. So that's interesting. More things to figure out. Yeah. Capital allocation strategy. Our OE has reached 15.1%, which is significantly higher than average of 9% for the TSE, 11% for other financial industries. Aiming to improve it. Okay. Bankruptcies exceed 10,000 cases for the first time in 11 years, driven by factors such as repayment peak of zero interest, no collateral, COVID loans, and rising prices. In addition, the number of bankruptcies caused by labor shortages, including difficulties in hiring and rising personnel costs, increased by 11.8% year on year, reaching a record high. I would like to know exactly what type of scenarios or what type of B2B transactions I deal with. The number of bankruptcy has been repeating a cycle and increasing and decreasing. It is thought that the number of bankruptcy has turned to an increasing trend. Okay. I mean, which should be good for their business, right? If there's more, no, bad for their business if there's more bankruptcy. Actually, let me think about that for a second. Is that good or bad? I think it's hard to tell, right? Because if there's more bankruptcies, you can say, hey, now I can charge you a higher rate. You know, instead of charging you 1.32%, I can charge you 1.7% at its peak, right? And also, you know, or it could be more bankruptcies means there's more defaults, so the higher the likelihood of you actually not getting paid because of a domino effect potentially. And then there's the other idea where it's like, oh, because there's a rising bankruptcy, companies are now more cognizant of, oh, there's more bankruptcies now, I better, you know, buy more insurance to ensure that because there's more bankruptcies going on, I better cover myself. So I do want to buy more of these policies, even though it's unlikely whoever the business that's buying from them is likely good for their money, right? So the dealership that's buying from Toyota is likely good on their money, but like because of the rise of bankruptcies, let's just be careful here and buy some insurance. Wonder if that's the case. Okay, rising uncertain factors. Rise in funding costs due to normalization of policy rates. Bank of Japan lifted its negative interest policy in March 2024. Funding costs have risen following the increase in policy rates. According to a survey by Teikoku Databank, 24.1% of companies cited rising interest rates with concern for the economic outlook, up 6.3 percentage points year over year. I mean, this doesn't really mean much, right? I mean, the thing is, in Japan, a lot of companies have cash, right? Right, and people still borrow money even though they have lots of cash on the balance sheet. So yes, they're affects earnings a little bit, but they definitely still have the cash or the assets to pay it off. But I guess it's hard to tell if it how that affects smaller businesses, like small and medium enterprises, let's say. Cost impact of labor shortages and wage increases. Teikoku Data Bank survey reported that 53.4% of companies identified a shortage of full-time employees, making the highest level since the onset of COVID-19 pandemic. In addition, 41.6% of companies cited labor shortages as a concern for the economic outlook. Labor costs are increasing due to rising wages and intensified competition in recruitment. Which is good for my stock glory, by the way. Let me think about this. What does this mean? You can't hire enough people, so your company goes bankrupt? Is that really a case? Because if you can't hire enough people, couldn't you just reduce output? Trying to think, what scenarios is having a lack of labor or of employees results in bankruptcy? Because for most companies that I see, right, like they all say like, oh, we want to hire more people, right? But then they're like, okay, instead of hiring optimally a team of 5, I have 4 people, right? And the 4 people are doing the work of 5 people, right? And if we think in the context of Japan, we all know that a lot of salarymen, they stay behind at work, not because they actually have something to do, but because their boss is around, right? So, those are two conflicting ideas, right? Either, I think the labor shortages probably affect companies like, for example, a convenience store, a restaurant that needs servers. So lack of servers results in lack of consistent customer service or adequate customer service because you have less servers. Or chefs, right? Maybe you need a certain number of chefs to maintain, adequate quality control, because if the chef is cut too thin in their workload, then you might not be able to output good stuff, good quality dishes. Okay. Growing uncertainty in overseas economies and trade policies. Concerns have been raised regarding the impact of U.S. tariff policies and supply chains, particularly among companies of high export dependence, or more cautious responses. Okay, this one actually is something out of the 3 that I've seen that probably has some merit to it. Yeah. What's an example? So example would be, what's a company I've covered? So SK Japan, right? So let's say you have a anime figurine or plushie provider from Japan who ships Hello Kitty, Pokemon plushies to the States for claw machines, for example, right? Or for GameStop or whatever, right? Let's say tariffs go to 100%, right? So now does the arcade fill its crane claw machines with Hello Kitty, or does it fill it up with Squashmallow? Right, or a cartoon that is an American-based cartoon, so like Spider-Man, made by Squishmallows, for example, right? So it'd probably go with a domestic producer in the United States, right, rather than a Japanese firm, right? And if it's a small manufacturer, right, one that is highly dependent on overseas sales, which typically is not the case, but let's say it is dependent, then that could ruin the business. Summary of key initiatives for the fiscal year ended March 2025. To raise the growth rate, we will make the necessary human capital investments and develop a structure that leverages those resources. Simultaneously, we will advance systemization of corporate screening and digitization of contract processes to strengthen both growth investments and supporting infrastructure. Before I even read this, I have a feeling like AI actually could actually benefit this business quite substantially, because like if you think about like, oh, hey, get AI to you know, let's say you're a lawyer at the firm, right? And let's get AI to draft a letter in the way that I've always drafted it to this type of company, right? And you can literally in 2 seconds draft a letter or an email asking for someone to pay you, right? Right. So it could be something where the AI literally spits out 1,000 letters for the 1,000 businesses, and then a lawyer has to go through each letter to sanity check it, make sure it matches what is required for each individual customer, and instead of having 10 lawyers going through things, you have 1 lawyer going through things, or two or 3 lawyers going through letters, for example. Expansion of human capital investment. In April 2025, we expanded our workforce with the addition of over 40 new graduates and contract employees. We also enhanced our recruitment efforts for April 2026 entrants. We're seeing over 7,500 applications, wow, and conducting approximately 1,700 interviews. So this company is definitely getting to pick people, right? So that's good. Establishment of, how many employees do they have actually? 1 second. I doubt it's actually in here. It shouldn't be in here. Is there a... This might be in their Japanese filing, honestly. Financial statement. Yeah, it has to be in their Japanese filing. Let me take a look. Let me think. Have a look. IR library security report will should tell me how many employees they have. Okay, let me quickly translate this real quick. So this is 8771 annual report. Translate that. Give me a second. We have 4 concurrent viewers. I don't know how many of you are former viewers from before, or are any of you new, but if you're enjoying the content, please subscribe. And you can replace 721637 in the top right. And you get a nice animation if you subscribe. Okay, so I have it loaded up now. How many employees do they have? Okay, so... March 2025. Okay, so employee count hasn't gone up. So they're being lean. So this is at odds with what I think that the company should do, right? If you're telling me I only have 10% of potential B2B transactions, right, and I have an entire field of 90% that's untapped, what should I be doing? I think I should be actively recruiting people with experience or knowledge about those different types of B2B transactions, hiring them to expand my potential sales potential, right? Because they're highly profitable, right? They can take years of loss. Like, why pay tax to the Japanese government? Tax is high. Why do that? Why not just actively invest? Sometimes I just don't get that for some companies. Establishment of support structures to maximize human capital. Increase in sales management personnel to oversee progress. Transfer of around 10 core sales staff to administrative departments to support client proposals, enhanced training structure, standardization, manualization of training process are underway. Good. We want something like that. System-driven operational structure. I would actually like to see employee count actually increase over time, not decline. Yeah. Due to historical differences in... Yeah, they only added 40 new graduates. So out of 1,700 interviews, 7,500 applications, 1,700 interviews, they took... What is this? Hold on. My brain's not working right now. 1% would be 7.5, right? So this is like... This is just over 4%. This is like, yeah, just over 5% here. Wait, hold on. Did I do that math correctly? No. That's just 0.5%. Sorry. That's 0.5% of applicants, right? And only like roughly just less than 3% of interviewees got a job. I think they're under hiring. System-driven operational structure. Due to historical differences in client-specific handling, some areas have lagged in systemization. We are progressing with categorization of contract types and beginning migrations to system development. Okay, I think they should have done that like a million years ago. That just seems like bad management, right? This, like, dude, if you're doing 10% of B2B transactions, of course you need to do some like systemization and categorize different types of B2B structures and having teams to target different or to handle different types of areas. That's how I would do it. Not have one person do every single type. That would be inefficient. Risk management and corporate screening enhancements. Despite a full year rise in abrupt bankruptcies, including fraudulent accounting, transition to proactive risk taking has been delayed. In response, we're enhancing frameworks to gather payment delay information and strengthening qualitative assessments, not reliant solely on financial statements. Okay. Aiming to double personnel involved in corporate screening, we are pushing forward systemization of basic screening processes and expanding contract staff recruitment. Yeah, okay, good. It's good. They recognize they need to be hiring more people, but I don't know why they didn't do that before. Like, literally, this company is rather profitable, right? Like, bro, why are you trying to pay more taxes to Japanese government? Why not utilize that, you know? Weird. Oh, these are things they did. Oh, okay. Oops. This is stuff they're gonna do in March 2026. Okay. As the first year monetizing prior human capital investment, year 26 will focus on enhancing sales enablement and training to accelerate employee ramp up. The goal is to drive a sharp increase in contract volume and strengthen marketing efforts in the second half. Continue human capital investment based on operational efficiency. Yeah, hire more people so they can do more monetization. I agree. Organizational reinforcement to accommodate accelerated growth in contract volume. Enhance the sales framework through IT utilization. Implement system-based support for client proposals. Like, this tells, okay, this is the impression I get. This is like your typical Japanese company that has a lot of paper. If you look at a TV drama, a J drama of this company, if that were to exist, you see an office full of paperwork. That's what the impression I get from this, reading this sentence. Enhancing back office functions for proactive risk acceptance. This will include improving our capacity to collect information on issues such as payment delays, refining credit screening logic, adjusting guarantee fees based on risk levels. I mean, they're not doing that. And further promoting the digitalization of back office functions. Improving the marketing. Improving marketing strategies to enhance renewal rate of existing contracts and acquire new business. We provide services to help companies address issues in risk management operations, driven by clients' growing demand for outsourcing and workload reduction. Promote the introduction of products designed for companies dealing with non-payment issues. Introduce products that can be easily integrated into daily operations and expand new sales channels, such as through Shinkin banks. Is Shinkin Bank a type of bank? Is a type of Japanese deposit institution. Shinkin Bank is a credit treasury. It's a type of Japanese deposit institution. They are cooperative regional financial institutions serving small or medium enterprises and local residents. Okay. Could be cannibalistic though. Preparatory steps will be taken for adjacent businesses such as financial, receivables, guarantees, and overseas operations. Okay. God damn. Okay, so this seems like the meat of what we need to do to understand this company. Seems like. Wow. Okay, let's read this. Visualizing credit and driving the economy. Leverage corporate activity data to visualize credit, unlocking new financial opportunities and fostering business growth. So input, business capital. Strong creditworthiness demonstrated by holding the industry's leading guarantee obligations. Leading. 1.885 trillion as of March 31st, 2025. So they're a market leader? Interesting. Product strength reinforced by unique business model. Operating profit margin of approximately 50%, significant growth potential in the B2B transaction market. Currently holding an untapped market rate of 98.5%. Okay. In addition, we target indirect financing of approximately 526 trillion and direct financing of approximately 252. Okay, I thought they said sub 10%, but now it seems like it's sub 2%, right? It's lower than that. Stock-based business model with new renewal rate of over 90%. Stock-based business model with a renewal rate of over 9%. Okay, if I'm getting this, understanding this correctly, it means that when a company signs on, you have a new contract, you know, they're 90% likely to renew, and then when they renew, they give you more accounts receivables to deal with. Which would make sense because if the company is growing, if their customers' revenue is growing, right, which it should over time, just because of inflation, right, and them not defaulting, right, then the AR book would continue to rise, right? So that's good. Intellectual capital. Corporate and transaction data obtained from guaranteeing over 350,000 companies is utilized for risk assessment. Acquiring and recording 2.6 million B2B transaction data points daily. What are the data points? So that's kind of misleading, but this is interesting. More than 360,000 companies are assessed annually. The company employs 210 employees dedicated to the single business of guarantees, including 122 sales personnel and 23 assessing personnel. A diverse and skilled workforce ranging from young professionals to experienced veterans. Okay. Social and network capital. 98 affiliated partners, including regional banks, with approximately 17,000 sales personnel. Okay, after reading so far, I actually came to realization that the 1.3% is probably that is a rate that allows the company, like the true line, if this is sports betting, right? The true line would probably be half of that, right? For the margins, operating margins to be so high, to be like 50%, it means like the actual rate, if this was a competitive market, right, should be in the vicinity of like 0.7%, 0.65%, somewhere around there. Right. Yeah. Social network have 98 affiliate partners, including regional banks, and approximately 17,000 sales personnel. Expanding number of risk securitization destinations. The number of funds have tripled over the past 5 years. Financial capital. Stable profitability demonstrated by 23 consecutive periods of increased net sales and profits. Business model that does not rely on its own financial capital by mitigating risks through securitization. A solid financial foundation with debt-free management and stable cash flow. Social challenge, stagnant Japanese economy, risk-averse stance of financial institutions, insufficient number of risk-taking entities. But at the times that customers do buy from them, they're overpaying for the policy, right? Growth strategy, eGuarantee, marketplace of B2B credit risk, a platform that facilitates trade and provides the necessary information to companies that want their risk to be underwritten and companies looking to underwrite risk in exchange for profit. The source of competitive advantage lies in enhancing risk assessment by leveraging the increasing qualitative data from business expansion. That sounds like a really nice mumbo jumbo, but like I think what it is essentially like they've identified businesses or certain scenarios that are highly profitable for them, and they're just honing in on that, right? For them to have such high margins, it means that the rate that they're charging is they're overcharging already, right? So they're going for essentially setups, or let's say qualitative data, qualitative or quantitative data that indicates that this is a home run, essentially. The B2B transaction data continues to expand as a number of customers and number of credit requests. Okay, so let's see. Increase in B2B transaction data. Assessment capabilities improve. Product quality increase. Product quality increase? I don't think so. Increase in number of customers. Okay, by product quality, you mean the customer service? Like, I can imagine customer service increasing because you have more money to pay for more personnel, so you have better customer service. Increase in number, sure, that could lead to increase in number of customers. Profit increase, reinvest into more business-to-business transaction data. Okay. Materiality. Focusing on the credit demonstrated by a company's actions, we create new corporate value, supporting businesses in their challenges and driving an active economy, building a made-in-Japan B2B credit risk marketplace, and expanding it globally. This would be interesting. I don't know how, though, they can do that, because they won't barely even tap the Japanese economy, so what are you talking about? Helping create sustainable value for both the environment and... Okay, let's not look into that. Output, guarantee the credit risk of B2B transactions and provide an environment in which companies can focus on business expansion. Yeah. Because typically if you're a business owner, this type of stuff can be a headache for not much gain. So if you can write it off for 1.3%, I think it's not bad. We guarantee transaction risk by providing guarantees for small, medium enterprises with limited credit management capabilities. Additionally, for large corporations and financial service providers, we offer tailored outsourcing solutions for credit risk management and collections. Okay. Offer financial institutions and fund investors the opportunity to gain income through risk underwriting. Provide institutional investors without expertise in corporate assessments with the opportunity to invest in CDS of small medium enterprises that do not have external ratings. Fund yields averaging more than 10%. So they're doing structured products too. Okay, contribute to stakeholders, shareholders, promoting a stock-type business model, maintaining a dividend payout ratio above 50%, ensuring stable returns for shareholders, clients. The company is working to realize market expansion by broadening the scope of guarantee services and offering many clients. Okay, that's good. What is their multiple again? Hmm. 11 times EV EBIT. Honestly though, if they've only tapped 1.5% of their market, this is definitely cheap. My question is, why the fuck have they been that passive in their growth? Like, how is it possible they've only tapped 1.5% of potential transactions, right? Or less than 10%, let's say. Right? Like, see, if I was a company, I would be, this is what I would do. I'd be, you know, fuck the net income margin. We're going to increase SG&A, you know, to handle more transactions. Right? Unless the rest of the transactions are it's kind of bullshit in that they've kind of tapped their niche quite well. Unless it's one of those scenarios where they've tapped their niche quite well, and haven't really garnered the attention of their competitors because they've kind of like just risen under the radar, maybe. That I don't know. That I don't have enough knowledge currently because they don't really say what type of B2B transactions they really do. Market size. Beyond the domestic market to exploit the Asian market. Now, do your domestic market, please. Like, fuck, you said 98.5%. Yeah, looks like subpar management. Like, honestly, like, what the fuck? Like, you're telling me you've been in operation for this damn long, you know, since the early 2000s, right? Or whatever the fuck it was. And this is the amount, you only tapped 1.5% of your market. Like, what are you doing? Right? Like, okay, trading overseas market and non-receivable as well, indirect financing such as loaning, direct financing such as corporate bonds. Okay, output, demonstrating credit through the company's actions and generating new corporate value by leveraging extensive transaction data to understand the actual status of corporate activities, business attitude, client evaluations, payment history. We aim to expand corporate credit evaluation, not dependent on financial statements or collateral. I mean, I would prefer collateral, thereby enhancing our capacity to provide funding. I think one of the reasons why they're doing so well is because they have collateral, so I don't know if that's a good idea. Contribute to fostering a social culture that values honest conduct. What? Okay. Financial solutions made in Japan that drive societal change. Wow. Working to create a financial model developed in Japan that facilitates a market for trading among numerous SMEs, separating risk from credit risk, and providing essential data for predicting default rates to support investment decisions. This project aims to expand investment opportunities while addressing the demand for low-cost risk hedging, focusing solely on managing risk rather than transferring credit. Providing sustainable value to the environment and society by motivating companies to take on new challenges. We provide an environment that allows companies and financial service providers to focus on creative work by reducing the burden of debt collection and transaction risk assessment, enabling them to expand new transaction opportunities and conduct ongoing corporate activities both domestically and internationally. We are building a foundation of risk underwriting that provides credit to diverse new businesses aiming to create a sustainable society. Well, okay, let's not get ahead of ourselves here. $20 billion. We're aiming to double the number of new inquiries and accordingly the number of new contracts. Okay, so let's say they do get a $10 billion. Okay, what is the company worth right now? What's their enterprise value right now? 68. Hold on, LTM is different. Okay. 55, 5.5 times. That's cheap. If this is true, this is not bullcrap. Like, if they're able to hit something like this. So they're okay. They're saying that they're in a transaction period where revenues almost double in 2 years. Right. If that happens, this company is cheap. I will tell you that. This company is cheap, right? But the question is, why expand this aggressively now? Why couldn't you have like built this foundation like earlier? Like did some shareholder or some CEO or the son took over or something? Something suddenly just happened where someone's like, oh, we should be more aggressive, you know, with our approach here. What? Okay. Okay. Master Trust of Japan. Custody Bank of Japan. Who is Masanori Ito? Who is this guy? Masanori Ito. President CEO. He owns 7% of the company, 6.5. Teikoku Data Bank. Oh, wow. NTT Data Bank. Data Corporation. Okay, so me and this guy. Is there another Ito in the list? No. How old is this guy? Masanori Ito of eGuarantee. How old is this guy? In April 2005, 10-year 20%. Directly owns 6.6% of the company, or 4.6 billion. So 46 mil, 30 million. Why not own more of the company? Right? Why not own more? What the fuck? This is very interesting. This guy's been at the helm for 20 years and now is decided to be more aggressive. I don't know. Load of bullshit here. I mean, there's some merit to it, but whatever. Okay, next. Guarantee liabilities relate to solutions to environmental issues. Guarantee liabilities relate to solutions to social issues. Wow. Regional revitalization. Startups. Alright. Okay. Overall, very interesting company. Now the idea is like, okay, we have 98.5% untapped. But then the question is, why the fuck did you not tap that? You know, you've been at the helm for 20 years. What are you doing? You know, like that's not what I'm understanding. Is like, you know, if the TAM is the total addressable market is that high, why did you not do this earlier? You know, like why wait until now? You know, like, and then what part of that market is just tapped by other people? You can say, hey, it's untapped for you, but have other people tapped in? Could it be the reason why they've only tapped 1.5% of it is because other people have tapped that other part of the market, right? That's what I'm trying to understand. So that's where, this is interesting. I think it's worth additional look at in the future. Yeah. What I say, number of contracts and customers, value of guarantee obligations over time, year over year, where is expected to go. How can bankruptcies decline yet net sales increase predictably over time? More salespersonnel means more. Yeah, so there's still things about the business model I'm not really sure about. Like, okay, for example, what are the types of B2B transactions they're doing, right? Like, they mentioned B2B transactions. What type are they? Is it for the financial sector? Is it like, and yeah. But it seems like, they are agreeing with me, but just agreeing, why wait 20 years? Like, it doesn't take a fucking genius to fucking figure this out, that they should be more aggressive. So it's either the business doesn't have that much growth potential to begin with, which is why they haven't invested that heavily into it, or they're just so anal about maintaining a certain high profitability margin that they just grossly not invested in the business. I don't know which is true, but worth looking into. So, thank you, Lenergy, for bringing this up. Good company. I think it's definitely worth looking into a bit more. Yeah, I think it's cool. I think this one's cool. I'm gonna steal this idea and add it to a potential stock pitch research I do later on. Yeah. Okay. Let's see how long I've been streaming so far. Hour and 17 minutes. Okay, I'm gonna take a quick 10-minute break, and then I will come back and do Oricon 4800. Okay, so just to capture you guys, so you guys come back, just capture your guys' attention. I will quickly go over. Chat panel doesn't work. Sorry guys, someone said the chat panel doesn't work. Why does the chat panel not work? Wondering what that is about. Okay, so what is Oricon? Oricon designs and operates websites. It offers news distributions, website management, consulting services, database and solutions, content for mobile phones, such as rankings and music information and customer satisfaction surveys. The company, okay, this is not the best type of description of what the company actually does. What this company does is it essentially performs these customer satisfaction surveys, right? From these surveys, it creates a ranking of what these companies do, what makes them good, what makes them not good, yada, yada, yada. Basically, it mines data, right, through these customer surveys, and it sells them to these companies for a fee, right? Let's take a look at the profitability from doing such a thing. Very damn nice, right? It gets these customer surveys, repackages them, probably do some data analytics, sells them to companies, so they can use it for competitive analysis. They also give away some of their research to universities, so they can to further advancement of academic. It's just YouTube. If you go full screen and back, it disappears. It's just YouTube. If you go full screen and back, it disappears. Sorry, 721, 637. I believe you are your reciprocation of goodwill. I can tell because you just reversed your number there. What exactly do you mean? I'm not really catching on. Because where are you commenting from? You're commenting on YouTube, right? Or chat panel doesn't work. Okay, let me even open a link for myself of the YouTube live stream. Let me see if I can figure that out. No, I see a chat. I see a chat. Yeah, I see the chat. It's like, hi guys. I'm gonna type that in the chat. I can even type it into my own live stream. I can type it in. So, not sure exactly what's going on, but YouGov is okay. Is that a different company? So is YouGov as cheap as this company though? Okay, so there's high margins, right? It's selling this data, right? It sources this data, sells it to people at high margins, right? Seems like, you know, they're doing a good job of that. Multiple wise, pretty cheap, right? If you look at it, like, you know, low EV/EBIT multiples, right? And good PE, like, you know, low enough PE, I guess. Good thing is revenues are increasing. Revenues are increasing, even though it's not like a high increase. It is increasing, right? Yeah. So I thought this was interesting, and potentially they have some type of, you know, moat or something around this, that's allowing them to sustain this type of profitability. But yeah, it seems like they've carved out a niche for themselves in certain categories, like for example, music. Yeah, yeah. So yeah, after my break, I'll look into this company a little bit more. Okay, I'm gonna take a 5-minute break. 10-minute break. 10-minute break. I'll be right back. All right, I am back. Okay, Oricon. So let's review some of the things about Oricon that are interesting. So revenues are increasing, right? I don't know if it's because people they've been doing more customer surveys or collecting more data, so they have more products to sell, or because they're just increasing their prices. I don't know. Profitability. EBIT margins have expanded, right? While gross profits increase, SG&A margin have been around the same level, right? So I don't know how they incentivize these customer surveys or but it means that they're able to do it at a lower cost, or they're just charging more for the data. Yeah, and trades quite cheaply in my opinion. And they have cash on the balance sheet. Yes. Okay, let's take a look at this company. What was looking at? I was able to convert this. Let me grab this converted data. Let's quickly draft up the enterprise data of this company and then continue from there. Actually, one thing I should have done earlier, which I didn't have a chance to do, let's take a look at eGuarantee's balance sheet, because if they have some investment secured, 16 billion in cash, 30K. Okay, before I do that, I'm going to quickly do enterprise value calculation of eGuarantee real quick, so that I 8771, correct, right? If I remember correctly, yes, 8771. So I'll quickly do that. eGuarantee 8771. What the date is? May 14, 2025. Share price 1475. That is very few shares. I think that's that, right? Right. Yeah. Okay, 70 billion market cap. $1,000 yen, millions. Yeah, we're doing this in millions. Securities, 300K. $2 billion in PP&E is all they need. $2 billion PP is around 20 million to house 200 employees. Okay, investment securities. Okay. Short-term debt. Okay, don't see any short-term debt, long-term debt. Nope. Nope. And no lease liabilities. So yeah, if they can generate 10 billion of EBIT in 3 years, yeah, this company is pretty cheap, honestly. Did he have some NCI? 7%. Dividend. 2.6%. How much have they spent on depreciation? Not a lot. That's barely anything. That is barely anything. That, yeah, because this is just, they just need personnel, right? This is a personnel business. You don't really need that to reinvest into equipment. They should invest into faster computers, though. I will say that. Yeah, pretty. I mean, sure, let's just do something. Let's say, yeah, pretty good. Yeah, then the question is, what happens when operating income goes to 10 times that? If we include long-term investments, yeah, this is cheap. Worth looking into more. Yeah, for sure. Okay, back to Oricon. TYO-8773. Yeah, I like Oricon. Because they're repackaging data, right? And that's good with AI too, right? Like, you know. Let's see. They need 160 million tangible fixed assets. 1.6 million. Market cap of 10 billion. Oh, not a lot of assets for this as well. Acid light, I like that. Investment securities, we have some. Insurance reserve fund. What is that? I'm just gonna ignore that. Yep, I don't know what the potential mode is. But okay, here's what it could be. Okay, so for example, a Billboard was a Billboard top 100, right? So for a period of time, right, people, if they're looking for music, they want to look at, oh, what is the hottest songs, right? The popularity wise, right? And if you're into pop music, you know, hip hop, rap, whatever, you look at the Billboard's top 100, right? So if someone uses something long enough and they're known as a reputable distributor of data that is not going to be tampered with, then they're going to be the go-to person, right? So similarly with these customer surveys, right? So the process in which they conduct these customer surveys is that they will do them, take out surveys that are conducted in a way that are fraudulent, potentially fraudulent, likely to be fraudulent or inaccurate, and then come up with a fraction, right? So if they built up a reputation over many years, it becomes a moat given time. So the moat is their reputation, if that makes sense. Yeah. So I think it's a reputation type of moat, if there is one. But good question. What is moat? I'm just curious. What is an insurance reserve fund? Insurance reserve fund could be like a rainy day fund, but it's way more illiquid than the. Hello, Alistair. Noron Ha. I remember seeing an Alistair, but that last name is throwing me off. Did you change your username? But hey, how's it going? Okay, I'm just gonna ignore the insurance reserve fund, but it's probably an asset. Let's be real. Okay, short-term debt. Okay. That's it. No lease liabilities, book value. No NCI. Okay. Alistair, are you a subscriber? Because if you're not, please subscribe. Okay, if you subscribe now, an animation will pop up and you'll replace 721637. You'll make him very unhappy. 36. 4.7%. Oh. Not bad. Not too bad. Okay, I'm gonna search. What the frick? Type of intangibles. Goodwill, software, and others. Makes sense. Nice. Yeah, so the questions I added are what is the moat, what is their reputation, what are they most known for, why is their gross profit margin expanding? Is it due to price hikes or price hikes or low cost of acquiring data? Okay, now let's take a look at the results, operational results. Oops. Okay. Okay, now what do they forecast? 6,000? Oh, nice. Oh, but operating profits aren't really anywhere. Okay, what's DNA like for this company? Cash flow statement here, buddy. Cash flow statement here. Yes, it is. Okay, so. Oh, similar to. This is kind of similar to eGuarantee in that their depreciation is also very low. Time deposits. What is that? Like cash deposits? Okay, tangible. Oh, okay. There's that, and then there's this. Tax 3% here. Okay. I don't know if there's anyone forecasting this company. It feels like it's a little too small for that to happen, but we'll take a look. Oh, wow. Well, this is the company's own stuff, so I don't know if they're gonna... Ooh, okay. 100, 145, 170. 100, 145. That is accurate. 170? Okay. What's CapEx? 130. That's distributed between these two. So if this was like 55, this would be 75? Yeah. Okay. Cheap. Cheap. Still cheap. So then the question is, okay, now we determine it's cheap. You know, how are revenues going to grow? Yeah. How can they utilize cash? Those are important questions we have to figure out. Let's take a look at their IP. So I kind of went through this briefly before going over it with you guys, but I'll read it again. Okay, Oricon has been reporting on the prevalence of fake news in a society where information is confusing. We aim to provide factual information from an objective and fair standpoint. Okay, that's bullcrap. But one thing to note is that their operating margin has been dropping, despite revenue staying stable or slightly increasing. So then the question of how do they raise their revenues is definitely something of concern for us. Gross profit margins have stayed stable, while operating margins have declined slightly. Sales have increased. Communication business is their biggest segment. Customer satisfaction, so customer satisfaction surveys, news distribution, I don't know what that means, but news distribution, data services, and mobile. Increase in revenue from customer satisfaction survey business due to news distribution PV covering the decline in business revenue. I think this is crappy translation. I think what this means in the increase in revenue from customer satisfaction surveys offset and the decline in the distribution PV revenue, I think is what it means. Mobile business takeover of this business. All shares of the subsidiary transferred to a company outside of our group. Okay, so it looks like mobile business is going to go down. If I'm reading this correctly, they transferred shares to an outside company. Asset light, so low investing activities, high cash flow from operating activities. Customer satisfaction, trademark use, digital quarterly performance trends, trademark use, digital promotion, customer referrals, and data sales. Search engine optimization measures taken to improve our site domain rating and put us in a favorable position. Personalize your rankings to get more valuable clicks. Landing page improvements and operational adjustments. Increase in advertising sales. Data sales. Contract rate increase in the overall ranking. Customer satisfaction more than the negative impact of ranking changes due to ranking updates. Ranking changes. Lost order due to. So loss. Okay, I think what that means is they lost revenue because they're not. If you think about SEO, right? SEO, search engine optimization, is you want to appear as the first result, right? So what they're potentially saying is because their rank has declined on that list, so that has impacted their revenue. I don't know if that's true. Might be. Large-scale campaign reduction. Cost-effective. Others. Trademark usage. Trademark usage. New contract. What does that mean? What does that mean? Data sales. Sending customers. Trademark usage. So someone uses Oricon and they can gain 688 million yen of revenue. What? Okay, customer satisfaction category ranking list. So this is what they do rankings for. So insurance, automobile insurance, direct type, agency type, motorcycle insurance. Okay, lots of insurance. Insurance, PF, FP evaluation, automobile insurance, direct type, agency type, fire insurance, pet insurance for small dogs, pet insurance for cats, medical insurance. Okay, so they do insurance, finance, online securities, IDECO securities companies, online banks, internet banking, foreign currency deposits, mortgages, FX, bank card loans, cryptocurrency spot trading, robo-advisors, credit cards. Okay, cram school. Wow, they do rankings for cram schools too. University entrance exams, current cram school, preparatory school, current private tutoring school. Okay, I can see how there's value in that during customer satisfaction surveys, so parents know what cram school does on their kids too. School, English conversation school, children's English, online English conversation, children's programming classes. Okay. Life, hometown tax donation site, water server, water purification, water server, house cleaning, moving company. Okay, communications, low cost SIM, low cost smartphone, mobile carriers. Okay, I see value in that. Housing, real estate agency sales. Okay, beauty salons, sport clubs, wedding, marriage consultations. Okay, that makes sense. Human resources, job hunting agents, recruitment information, travel, business. But what happened to music? I feel like music should be one of them, right? News distribution, PV business. Decrease in tie-up advertising and content provision to external media. News distribution. Changes in the number of sessions for our media. Oricon News. What? Wait, do they actually distribute news? Like TV wise? I think it. It's probably something to read about in their securities report. Google AI overview. Okay. I'm going to quickly look at if there's any explanation of what they do here. Communication business. Okay, in the customer satisfaction survey business, we mainly use trademarks, digital promotion, customer referrals, and sell data. The performance obligation of trademark usage is to provide the right to use the trademark related to customer survey ranking owned by the group for a certain period of time. Since the nature of trademark usage is that the customer grants the license to use a trademark for the trademark usage period, the group accounts for the usage period as if the performance obligation was satisfied and measures the progress of the performance obligation based on the trademark usage period. The performance obligation for digital promotion, customer referrals, is to refer users to customers through CS ranking. The performance obligation is satisfied when a user refers a customer to the customer's website through CS ranking. And therefore revenue is recognized based on actual number of customers referred. The English here is not making much sense. I think I need to actually go through and actually translate it with ChatGPT tomorrow, probably. Yeah, the performance obligation of data sales is to deliver the data to the customer. That makes sense. The performance obligation is satisfied at the time the data is delivered to the customers. Of course, so revenue is recognized, yeah. This one, I'm wondering if it's like, okay, you can name drop Oricon as the customer survey provider if you're using specific data from Oricon, right? So if you cite a survey from someone, it increases the credibility of whatever you're stating, right? So this could be reputation based. So when a customer sees, oh, Oricon is on there, I must be trustworthy, correct? The second part I'm not getting. So the performance obligation for digital promotion is to refer users to customers through CS ranking. The performance obligation is to refer users to customers through CS ranking. The performance obligation is satisfied when a user refers a customer to the customer's website through CS ranking, and therefore revenue is recognized based on actual number of customers referred. So I don't know how the digital promotion ties into customer satisfaction surveys. I understand what it says like as an idea, meaning like, okay, if we generate more customers that go to your website, the number of actual customers referred, I don't know what the metric is, like referred to someone who actually makes a sale or something like that, or just literally the number of people that go on, and like, okay, maybe it's something like, oh, if 1,000 users go into our website, then we get paid X amount. I don't know. In the news distribution and PV business, we mainly engage in advertising business using our own media, Oricon News, and distribution of news articles. Okay, so they actually have a news outlet. The main performance obligation in the advertising business is to display advertisements from customers on Oricon News, which is our own media. The performance obligation is satisfied when the advertisement is displayed to the user, and therefore revenue is recognized based on the point of time. Okay. The performance obligation of the news distribution business is to provide news articles to customers based on the contract. Since the performance obligation is satisfied at the time when the news articles are provided during the contract period, revenue is recognized each month in accordance. Data service business. In the data services business, we provide marketing data for music software, video software, and books. Okay. The performance obligation related to the contract for the monthly provision of music data is to provide music data every month based on the contract period. Since the performance obligation is satisfied at the time when music data is provided to customer, revenues, okay. Performance obligation in the contract to grant the right to use music information is to grant the right to use music information. In addition to basic fee, the customer pays a usage fee according to the amount of music information used. Since the amount billed to the customer directly corresponds to the value transferred to the customer upon satisfaction of the performance obligation. Mobile business. In the mobile business, we provide services such as distribution of music, books, and other content for mobile devices. I mean, isn't there something called iTunes? Or Amazon Kindle, something like that. The performance obligation for content distribution services such as music and books is to distribute content to customers. The performance obligation for content distribution is deemed to be satisfied when the customer purchases the content and revenue is recognized at that time. The only way I see that this becomes somewhat makes sense to me, I'm not really sure, is if they have a ranking of, let's say, songs, right? Or albums, let's say, and someone actually clicks the #1 album and makes a purchase, then they make some money. That could count as distribution. I don't know. An advertising business company mainly plans and manages advertising events. Performance obligation is satisfied when the planning and management is completed based on the contract. Okay. Okay, everyone. So Oricon's worth looking into more. Today we've already done a 2-hour live stream, so I will continue doing research on this company tomorrow. It's kind of like where I am. So thanks for tuning in. Jason Tread, 71637, and Alistair Nuronha. So thanks for tuning in. Thanks for engaging. Hope you guys were able to extract some findings and this potentially helped you guys with idea gen. I will be hopefully finding the gem of a stock for my upcoming stock pitch. Hopefully I can find something, but I haven't nailed something down yet. But this Oricon looks like it has potential, and also the eGuarantee also looks like it has potential. So yeah, thanks for tuning in. I'll catch you guys tomorrow. Later.